Hello and welcome to the new and improved Crypto Byte from Market Rebellion. Today we're going to be taking a look at ETH 2.0. We're going to be talking about why it's important, what this transition means for Ethereum, and what you should be paying attention to as some possible opportunities that may arise from this transition. And if you've been in crypto for a while, you know that ETH is one of the oldest and most battle-tested chains in existence, second only to Bitcoin. And whereas Bitcoin is more valued on its scarcity, ETH has been historically valued for its flexibility and its utility. And this flexibility is about to be put to the ultimate test with the implementation of 2.0. So we're going to tell you a little bit more about that, how ETH is preparing to make that transition, and what exactly it means for the entirety of the crypto space. So without further ado, let's dive into things. One of the biggest and arguably the most important change that's coming along with ETH 2.0 is a transition from proof of work to proof of stake. This is a massive change and a big test of ETH's flexibility. No other blockchain has changed its consensus mechanism, especially with this much at stake, no pun intended. There's currently $35 billion staked in Ethereum in anticipation of this merge. And the reason why they're doing this is several-fold. One being that proof of work is incredibly computationally extensive. It requires a lot of energy, and as a result has come under fire recently as a way of using too much energy in a non-practical manner. In fact, CJ and I used to mine Bitcoin in our college dorm rooms. They were so energy intensive that during the cold Midwestern winters, we didn't even need to turn on our heaters because they were generating so much heat that it literally was 80 degrees in our room at all times. So it is very, very energy intensive, requires a lot of electricity, and as a result has come under fire. So this switch to proof of stake not only makes it more environmentally sustainable, but also it aims to make ETH more scalable. So we'll talk about that a little bit more when we talk about sharding in just a minute, but essentially what this aims to do is increase the throughput for Ethereum. So where now it can only handle about 30 transactions per second, they want it to be able to handle 40,000 transactions per second, which would greatly decrease the congestion on the network. So that is one of the biggest and most important switches, but let's keep going and talk about why it is so important.
So let's talk about what the merge exactly is and what it could entail. So Ethereum will move from proof of work to proof of stake during the merge, and that is scheduled for the fall of 2022. There could be delays though, as there has been historically, which has pushed price a little bit down following those delays. Nevertheless, it should be really interesting to see what kind of impact that will have in the market in the fall of 2022. Starting off with the two chains, we have the main chain, which is Ethereum's proof of work consensus, which is currently the main structure of Ethereum. And then you have the new proof of stake chain known as the Beacon Chain, which is also being created and running parallel to the proof of work chain. Currently, retail folks and particular institutions have staked about $34 billion worth of Ethereum on this Beacon chain that cannot be unstaked or withdrawn until the ETH merge is complete. And like I mentioned, that could be delayed. The interesting thing about the merge, and once we transition from proof of work to proof of stake, is that these individuals will be able to unlock their ETH, and many have been staking since prices well below $2,000. So many have thought that maybe some will sell after they have the ability to actually withdraw their ETH. But I think there's an interesting argument for why they will hold, or why you might even see institutional investors join the ETH proof of stake staking party. And that has to do with staking rewards and specifically yields. Right now on the main chain, miners and stakers receive roughly 4 to 5% APY interest in order for that staking and validating the network. However, those miner transaction fees and those miner rewards that were paid in the proof of work system will now be transferred to stakers following the merge in fall of 2022, which will then increase the APY rewards for those proof of stake stakers to approximately 5%, and it will double to roughly 10 to 12%. So there's an interesting argument to be made that that will actually increase the demand and offset any potential sellers who would like to take profit after locking their coins up for a couple years. That'll be very interesting, and we'll see it in the fall. Next, and one of the most exciting aspects of Ethereum 2.0 is its move towards ultrasound money. The folks at Ethereum like to call this ultrasound money, taking inspiration from Bitcoin, known as sound money, and how many economists like to describe it. The way that Ethereum will ultimately become ultrasound money started in 2021 when Ethereum Improvement Proposal 1559 voted to actually implement a feature which will burn every portion of an Ethereum transaction fee. So ultimately, the more Ethereum is used and the more people interact on the network, the more ETH will be burned as a result. In the past year since this improvement proposal has been implemented, already 2.2 million ETH have been burned. And so we're only going to see more of that as the apps within Ethereum continue to be used. Also, the really interesting thing about the merge is that that sound money and that voyage towards it will be only further reinforced by issuance being cut. Currently, Ethereum issues about 5.5 million Ethereum per year, but that number will be cut to only 500,000 ETH at the start following the merge. So it's going to be very interesting to see how these tokenomics ultimately impact price and what effect they have when Ethereum moves from an inflationary environment to a deflationary one.
One big change that we can expect after the merge is the change in participants in ETH. Right now, and historically, we've seen a lot of retail participation driving the market, whether it be the DeFi craze of 2018 or more recently the NFT craze of last summer. Both of those have served as major catalysts for positive price action. But with this switch in tokenomics, we can expect ETH to be driven more by scarcity. And that's something we've seen with Bitcoin in the past, and that's acted as a catalyst for positive price action. And in fact, we've had companies like Tesla, MicroStrategy, and Square adding Bitcoin to their balance sheet because of those supply and demand dynamics. So now that ETH is switching to a more deflationary tokenomic model, we can expect similar participants to come in, and we can expect those institutions to start participating more heavily in ETH 2.0.
Yeah, thanks, Monty. I think it's fair to say that no institution really wants to be first, and they don't want to be last either. So I think if we see a very successful merge actually go through, no tech problems, nothing like the DAO in 2016, I think that specifically for pension funds as well as hedge funds, that yield of roughly 10 to 12% on an emerging asset that's going forward into the future with a lot of growth potential, I think is something that could be very attractive. If you see those institutions involved and you actually see institutional participation, you just think back to like when Tesla bought in and when all those other companies bought in, that changed the tone of the market and the perception around Bitcoin at the time. I think the same could be true for ETH if we see some institutional staking. What I think is really interesting and might actually create some opportunities after the merge is actually specific like chain reactions and interesting plays specifically allowing institutions to easily participate within these staking. So those are some themes that I'm excited to check out.
ETH is not the only asset that's going to be affected by this switch to ETH 2.0. You can expect many other assets in the space to see some incredible price action following this switch as well. So let's break that down and a lot more after this.
Want more from CJ and Monty? How about 2 new trade ideas per week, global online chat, over 35 video lessons for beginners and experts, proprietary charting software, and so much more. Get in the crypto room today. Get started for just $7.
Welcome back. As institutions enter the cryptocurrency space, they want to work with reliable custodians. There's so much hacks in the cryptocurrency space that they need the responsibility to have their clients' money safe at all times. NEXO is an interesting company that could provide such services for institutional staking following Ethereum 2.0. NEXO token is also quite interesting because if you're a fund or an institution that holds a certain amount of NEXO tokens on their platform, they'll actually provide a boost in interest to the other assets that you hold. So you could imagine a situation where if institutional demand for Ethereum 2.0 staking hits a company like NEXO, perhaps they have very good incentives to then buy the NEXO token. It's not financial advice, I don't currently hold any NEXO, but it could be an interesting story to play out. What I like also is the fact that NEXO performed a $100 million buyback of the NEXO token in 2021. The address is public and listed on Etherscan for anyone to see.
Another asset that we think is worth a watch post-merge is LIDO. CJ, I know you've been watching LIDO. You actually hold a little bit of it. Care to tell us a bit about that?
Yeah, LIDO has had a lot of interesting momentum leading up to the merge. It's already got around 22 billion in total value locked. But essentially what LIDO does, it allows people to stake and have much more access to liquidity. So for instance, in many proof-of-stake systems, when you want to validate the network by staking your funds, there are certain lockup periods. On the Terra ecosystem, if you want to stake Luna and earn those validator rewards, it takes 21 days to be able to unstake those funds, transfer them, sell them, do whatever you want with them. However, with LIDO, they will essentially give you the liquidity to be able to sell or buy tokens whenever you want for a small management fee, of course. But the growth in total value locked is something that I think is quite interesting and could continue to grow here following the merge. So as a result, I hold a little bit of LIDO, and it's something that I'm going to be watching very closely going into the fall.
And it's not just staking protocols that we expect to see movement following the merge. We also expect to see movement in layer 2 assets and also alternative layer 1s. Starting with layer 2s, we've had assets like DYDX and Loopring. Both have seen some incredible price action in this last year. With ETH's switch to ETH 2.0 and this fundamental shift in the way it's perceived, I also expect to see an increase in the way people trade these layer 2 assets, including Loopring and DYDX. But I think one of the most notable examples of areas to watch following this merge is the alternative layer 1s. The alternative layer 1s have been the biggest story of the last 2 years in crypto, basically, from Luna, Binance Smart Chain, AVAX, Solana, Near, and many more. Those have been some of the best performers of the last 2 years. And that's no coincidence. It has to do with ETH's shift from a utility chain to a more store of value, scarcity-based model. So when we see this transition, it's definitely worth noting. Even the founder of Ethereum, Vitalik Buterin, said the future will be multi-chain. It's not going to be one chain to rule them all. So you can expect to see several different chains all existing together in the future. And that's why we think that Solana, AVAX, Luna are all worth the watch following this merge to ETH 2.0.
Yeah, one of the common arguments that a lot of ETH holders will put forth following the merge is that, people are just going to go to Ethereum once gas fees are solved, but that's not something that will be immediately fixed in the move to Ethereum 2.0 following the merge. So users will still have to deal with those Ethereum gas fees, which I think leaves a lot of opportunity on the table left for a lot of alternative layer 1s like the ones you mentioned. The transition from proof of work to proof of stake will be Ethereum's ultimate test of flexibility, and it'll also have a lot of repercussions on institutional participation within the cryptocurrency industry. The launch of Ethereum 2.0 and the merge is scheduled for the fall of 2022. It should be very interesting, and there's a lot of assets to monitor going up into that merge. Thanks for watching. I'm CJ Reichel.
And I'm Monty, and we'll see you guys in the crypto room.